on the brink of disaster. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major industrial superpower is now on the brink of total collapse. I'm going to show you who it is, what's causing this problem, and why nothing the political elites are doing is helping turn this country around. And if this country goes down, well, what it means is that every other major industrial superpower is going to face the same problems. And what it suggests is that things, even here in the U.S., as you're about to see, are going to get much worse. Now let's go to Bloomberg, where we picked today's story up with a headline: UK Christmas retail sales disappoint as shoppers pull back. Now you might be wondering, why are we talking about the UK? Why does it matter about retail sales? Well, it's really simple, because in every major economy, the consumer is approximately 70% of the economy. So when you see consumers pull back on their spending, well, eventually it hits the factories in terms of new orders and hits all other areas in terms of demand. And as demand goes down, well, it usually has a major impact on the labor markets. Now, you might remember from weeks past, what did we hear out of the UK? The consumers there, well, they were deferring their spending, or they were holding back and just waiting to unleash it. Well, now that tune has changed in a big way, as total sales grew 1.7% in December, compared with almost 7% growth a year earlier. This according to the British Retail Consortium. Sales of non-food items declined over the 3 months through December, with shoppers particularly avoiding big-ticket purchases such as furniture and homeware. Clothing, jewelry, and technology were other gift categories that struggled. So what you're seeing here is consumers are struggling under the weight of inflation. It's not that they don't want to buy those things, because they always want to. They just can't afford them. They can't get the necessary credit, or they're starting to get concerned about their job and their ability to make payments on loans. And so they're steering away from big ticket items and non-food purchases and focusing more of their efforts on the day-to-day struggles of just putting food on the table. The weak data may stoke concerns that the UK economy could tip into a recession as consumers worry about their financial security. And they have every good reason to worry about it, because when we get to the story on what's going on with this industrial superpower, what is happening there is going to happen to every major economy around the world. The worst part is it's going to happen very quickly afterwards, suggesting things indeed are going to get worse. Even as inflation eases in the UK, shoppers are still having to spend more to get less, and many are focusing on necessities such as food, heating, and housing costs, putting all those big ticket items on the back burner. And that is an issue here, because when people stop consuming, as you're about to see, it means a lot of other people are going to lose their jobs. As we look at advanced retail sales, here is the U.S. data shown in blue on a year-over-year rate of change against continued unemployment claims shown in red. And what we can note is that a slowdown in retail sales puts people on the unemployment line, and even worse, it keeps them there because they have a hard time finding another job when other retailers, wholesalers, and manufacturers are struggling because nobody wants to buy. We see that happen again in the global financial crisis. Just as soon as retail sales really start to slow down, well, continued claims rise. Of course, as we know, the people on unemployment have less money, so naturally they are only going to consume less. And what happened here now, we see continued claims move up to 1.855 million. Of course, we'll get an update on Thursday. And what did that mean for retail sales? Well, they came crumbling down. And what do we continue to hear from the political elite? Is the labor market is strong. And yet here in the U.S., and we're seeing in other parts of the world, retailers, wholesalers, manufacturers, everybody is still holding on to employees. The question remains is for how much longer? Because once that happens, once we start to see the layoffs pick up, it's not just going to be in this one major industrial base that's struggling. It's going to be all around the world. The difficult environment for retailers is expected to continue this year as shoppers see little respite from higher living costs. The situation will be worsened by shipping delays due to the unrest in the Red Sea, as well as increases in business rates and the national living wage from April. So here you can see in the UK, as of course, retailers are forced to pay higher wages. What is that going to mean? Well, they're going to look and see the sales are down, sales are slowing, and that means they're going to need fewer workers. course, that also turns into those workers hitting the unemployment line and in turn consuming less. And so you start to see how this builds momentum to the downside here for these economies, because many people keep hoping, when is everything just going to break and collapse? Well, the bigger economies are, the longer it takes to slow them down, and that's what we're seeing right now. As weaker retail performance may revive talk of technical recession, defined as 2 consecutive quarters of contraction. And that would be a bleak backdrop for the prime minister there to attempt to win a re-election, and it could also spur speculation that the Bank of England will move toward cutting interest rates. Well, I've got some news for you. There is absolutely no correlation to retail sales and, of course, what we know, our central bank policy. We never hear the Fed or any other central banker talk about retail sales, and so any notion from the mainstream media that that's likely to happen and there's a relationship, well, it's very simple. We can see, of course, going back to the dot-com bubble, it wasn't until retail sales almost ground to a halt at a 0% year-over-year rate of change before the Fed started cutting. They were cutting well in advance of a slowdown here going to the global financial crisis, and right now retail sales are pretty slow, and that's not doing anything in terms of what the Fed's plan. So how does this then backfeed, of course, where we started with a story of this major industrial base? Well, that's what we're doing in Germany today, because as we've noted before, when Germany goes down, it's going to take all the rest of the Eurozone with it. It is a manufacturing powerhouse. But the problem is what we're seeing in Germany is going to happen in the UK. It's going to happen in China. It's going to happen in Japan. It's even, as you're about to see, going to happen here in the US. As German industry shrinks for the 6th straight month as recession looms, as now industrial production has declined 0.7%, as economists only thought there was going to be a 0.3% gain, suggesting that the German economy that everybody said was going to recover is going to continue to head down. We said this was a demand issue, not because consumers don't want things, it's because they don't have the wage growth to afford it. They have too much debt, interest rates are too high, and they have less money to spend on discretionary side, and that was eventually going to hit these manufacturers in a big way. But something that you can take advantage of if we see the global economy falling, well, that means interest rates are going down and bond prices are going up, and you could have grabbed on that opportunity. It's still not too late, because we've got our CTA Timer Pro, and what this is a very unique program that looks at how the machines are positioned in the market. But what we do is we give you an edge by running an historical overlay. So what we saw is back in late October, early into November, is a machine positioning on TLT, the long bond that no one wanted to touch, was at historical extreme positions. We told our subscribers, when this flips, this is where you want to buy. And good news, we're going to make these reports even easier to read this month. We're going to give you these signals right on the first page. And right now you can grab a free month. There's 3 coupons for each one of them, because our Momentum Timer Pro, when you pair the two together, here you can see on November 2nd, this is our technical analyst report, where we look at all those technical signals like the RSI, the MACD, the Stoch, and all those other ones. We smooth them all out into one simple signal. And what happened? We saw from a deep short position on the 1-month signal, we got one daily buy count as technicals started to turn up. You pair that together, you would have bought on this candlestick right here, and even after this pullback, you'd still be up 11.6%. Again, grab one of those coupons in the description below. If you get to checkout and there's no box, I mean, 3 people beat you to it. Got to wait for another day, as Germany probably ended 2023 with its first recession since the pandemic, as analysts reckon data will reveal a 2nd straight contraction in output in the 4th quarter. Manufacturers, Germany's economic backbone, are struggling from costly energy, higher global interest rates, and a slowdown in China. Well, what they're really struggling with is a slowdown of the global economy. And as we've noted, everybody wants to hold on to employees right now. That is the goal. The problem is, as demand continues to fall, as backlogs continue to get worked away, and there's a lack of new orders, there's only so much money to go around before these manufacturers have to start laying off. And the figures come a day after a reading for factory orders also fell short of expectations. Additionally, with the government straitjacketed over ramping up investment and train strikes looming this week, few economists anticipate much of a pickup this year. And what did we continue to hear? That even as we've noted, that Germany's manufacturing sector was in an outright depression. Everybody last month got hopeful and said, look, the data's starting to turn around. Everything's starting to look better. And we said, hold tight, because if it rolls over and continues to go down, what it suggests is what's coming for the global economy is going to be outright dire. And what that means is, of course, the labor market around the world, as central banks are patting themselves on the back saying, look, we did it this time. We brought inflation down. We kept the labor market intact. Well, good luck with that. There's only one time in history that we even saw that, which I'll show you here in a moment. As we look at industrial production, this is the U.S. data against continued claims. And we can note that slowdowns in industrial production, well, you can see it bottoms out continued claims, and then they start going up as people lose their job and can't find another one in their chosen profession. You see that here again in the early 1980s. How about going in the late 80s, early 90s? Same relationship. Then again, on the dot-com bubble, they're almost in sync. As industrial production gives up, retail sales go down, people hit the unemployment line. And once again, during the global financial crisis, and again now, and the issue right now is the fact that people are sitting on unemployment. So the longer they're on unemployment, that means the less money they have to spend in the economy. With interest rates still high, there's more money going to debt service, less money into the real economy, and eventually the money dries up. Now, there was one time in history I mentioned we saw a contraction in industrial production. That was when we almost had a global recession, and notably what averted it was the fact the U.S. economy was rather robust, and people losing their job were able to find a new one. You can tell this time it's not different. That was one time it was. And speaking to Bloomberg after Tuesday's data was released, Holger Schlemending, the chief economist at Bernsberg, said Germany is experiencing cyclical rather than structural issues. Of course, I take a complete opposite view of that. This is not cyclical. This is what happens when you pump the global economy, a debt-based economy, with fiscal and monetary stimulus, and then you yank the reins out from underneath it. You completely invert the yield curves and the money curves, keep the banks from lending, keep them from creating enough new money to support all the debt that you created during, of course, the pandemic and that level of growth that everyone said was the new normal. And next thing you know, things don't just reset back to where they were. They actually go past that. And that's the danger here. This is not cyclical. This is indeed structural. And he says it will bounce back as the manufacturing sector returns to, quote, significant growth. In the second half of 2024, we'll say that that is a very optimistic view at very least. And Germany was in a recession last year, but the indicators are starting to stabilize. We're bottoming out in the German economy. It only makes me wonder if he actually did look at the data today, because there's absolutely no indication that the German economy is turning around or the UK economy is turning around. And now let's take a look at what's going on in the US economy, because we're going to make the case of what's happening in Germany is eventually coming here, and maybe sooner than we think. As U.S. small business optimism rises to 5-month high on earnings, owners, of course, now less negative. So this would be a good sign at face value if business owners are more optimistic. Well, what does that mean? That they're seeing more foot traffic, more sales, more revenue, that means they feel good about things. The problem is they have no idea, and maybe they do, of what is coming. A National Federation of Independent Business Index of Sentiment rose 1.3 points last month to 91.9, the highest since July, and matching the best reading of last year. Owners were less downbeat about the outlook for business conditions, and only a net 4% expect lower sales in the next 3 months, the smallest share in nearly 2 years. So maybe what we have the case is that business owners were just so beaten up over last year that they're now saying, well, things can't get much worse. The problem is they're going to. And here we can see advanced retail sales. This shown in blue on a year-over-year rate of change against the net percentage of domestic banks tightening standards for credit card loans. And what we can note is that when banks are not extending credit to consumers, well, they can't spend, because we know here in the U.S. people love to buy things they don't need with money they don't have. And sure enough, retailers are thinking that this is going to be a big turnaround, but in reality, it's not at all. The opposite is about to happen, unless maybe more people are doing this buy now, pay later stuff. In that case, maybe they have some reason to be optimistic, but the labor market suggests otherwise, because now when we take retail sales and we overlay total compensation shown in red, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, also shown on a year-over-year rate of change, that as payroll growth slows down, as that total compensation slows, that means retail sales slow. Of course, we note that if consumer prices are not rising, mean, we're going to get an update on that this week, that means, of course, higher wages cannot be passed on. So what we expect to see is a continued trimming in hours worked, total compensation to go down, retail sales to fall, and that means all of these small business owners that think the worst is behind them, well, they're wrong. Small business owners remain very pessimistic about economic prospects this year, as inflation and labor quality have consistently been a tough complication for small business owners. They're not convinced it will get better in 2024. Well, inflation is indeed going to come down, but so is demand in a big way. In terms of labor quality, well, I think the bigger issue is going to be is when they're forced to finally lay off, and that's something we can see right now, at least they don't want to do. But as we note, of course, as retail sales go, well, that means consumer price index is going to go with it. Here you can see a beautiful relationship between the consumer price index shown in red against advanced retail sales in blue on a year-over-year rate of change, suggesting that, as we have noted in the past, that the consumer price index is indeed a proxy of demand. As demand goes down in terms of prices flattening out, that means retailers are in fact in big trouble, and these small business owners have no idea what they're about to face this year. And if they could look over to Germany, look over to the UK, look at what's going on in the global economy, they're going to see that this year there's going to be major problems. And as we'll look to China in a moment, I can tell you exactly what they're soon to do. And 25% of firms reported higher prices in December compared to 3 months ago, holding at the lowest levels since early 2021. However, that share was more in the range of 10 to 15% in the 2 years leading up to the pandemic, suggesting that, as we know, that higher prices are not going to be absorbed by consumers right now because they can't afford it. They don't have the compensation growth to hold on to these prices, meaning retailers are going to see even less demand. They're going to be forced to lay off even some of their employees that they don't want to, but they'll have, again, no choice as sales continue to drop off because many owners are still reporting difficulty filling open positions. Well, they're not going to have to worry about that much longer. And attracting quality candidates. More firms on net reported recently decreasing headcount for a 9th month, matching the longest streak since 2011. So they can't find the employees they want, but they have no problem getting rid of the employees they don't want. One of the issues here is going to come back to maybe they can't afford the employees they want because they just don't have the pricing power to pass that on and higher wages. And what that means, what's happening now in China, well, that will soon be here in the U.S. As price wars break out among consumer brands in China as growth slows, and Chinese consumer prices are now falling at the steepest pace in 3 years, triggering fears that the country will enter a deflationary spiral. And while central banks in many parts of the world are focused on taming inflation, the PBOC vowed to use monetary policy to push prices higher, and if only it could. Of course, we know it can't do that, and that will eventually happen here in the U.S. because all these retailers and wholesalers are stacked up with massive amounts of inventory. They're going to see that just start to linger on the shelves as the economy slows down, and they're going to see fewer and fewer consumers come into their store, and those that do are going to spend less. At some point, they're going to realize they're going to have to clear this inventory and put money in their pocket, and that means a deflationary spiral will be here this year. The low price strategy was widely used by consumer brands last year as the economy was under pressure and consumer confidence was weak. Of course, we can see that this means deflation trend will continue in 2024 in China, and that does not bode well, of course, for the rest of the world. And we're starting to see that sign now that consumer demand is indeed going down in the U.S. As U.S. trade deficit data came out today, unexpectedly narrows as services surplus rises, and this is not a good sign because as America is the world's largest consuming nation, the world's largest importer, we need to see that trade deficit widen, which would then mean the global economy is coming back online and the U.S. consumers are eager to spend, when in fact we see the opposite. The deficit in goods and services trade shrank 2% from the prior month to $63.2 billion, this according to the Commerce Department. The median estimate in Bloomberg poll called for a 64.9. Of course, this completely missed expectations. The value of imports and exports each decreased 1.9%, suggesting demand not only internally to the U.S. is going down, but externally around the world is falling as well. These figures notably are not adjusted for inflation. And sure enough, as we look at advanced retail sales again in blue on a year-over-year rate of change against the trade balance of goods and services, what we can see is when the trade deficit actually shrinks by the red line going up, well, that means demand here in the U.S. is going down, as are sales. You see that here again in the global financial crisis. We note that, of course, the trade deficit shrank in a big way. Of course, demand here from U.S. consumers collapsed also in an equally big way. And now we're seeing the trade deficit steadily rise, retail sales come down, and yet what do you hear from, of course, the National Federated Independent Businesses is that small business owners are optimistic somewhat. Well, that optimism isn't going to last a whole lot longer, because where, of course, the German industrial base, their manufacturing base goes, it flows out to the services sector, and that means countries like the UK, the US, and China, we're all in big trouble as we head into a globally synchronized recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.